Just meeting that minimum requirement for your credit score doesn't mean you're going to get the best deal, however. Your credit score greatly affects your interest rates, which of course will affect your monthly mortgage. Do you ever wonder what credit score you need to have in order to buy a home for the first time or to just buy real estate in general? Sure, a lot of people talk about having a good credit score, but not a lot of people actually know what a good credit score is or how credit scores are even calculated. So in this video, we're going to talk about exactly how credit scores are calculated, what credit score you need to have in order to buy a home, as well as some tips to help improve your credit score. Also, don't forget to smash that like and that subscribe button and let me know in the comments what questions you have about credit scores. First, let's break down how your credit score is calculated. 35% of your credit score goes into you paying off your debts in time. This is the biggest part of your credit score, so it's very important that you actually pay your bills when they're due. Lenders want to be able to trust that you will pay off your debts in time. If you're not paying off your debts or you have debts that are past 30 days due, lenders simply aren't going to trust you, and that's going to bring down your credit score. The next 30% of your score is going to come from the total amount of debt that you owe. While having credit is a good thing, maxing out your credit cards or maxing out your debt is not a good thing. If lenders see that you have high balances on all your credit cards, quite frankly, they're going to see you as risky, as one little thing can go wrong for you and before you know it, you're not going to be able to pay off those debts. Lenders like to see that you have the credit cards, but you're able to keep them at a low balance. This shows that you know how to deal with debt and you know how to handle it without going overboard. Larger debts such as your student loans and your mortgages are also in this category. The more you pay these debts off over time, the better your score is going to get. Keep that in mind if you ever decide to refinance because you think you're going to get a smaller payment. While that may help lower your payments, it will most likely make your credit score worse. The next 15% of your score is based on the length of your credit history. The longer you've had debts, the better it looks in the eyes of lenders and the better your scores will be. This is why it's so important to not cancel any old credit cards that you have. What you should do instead is just pay the balance to zero or keep the balance as low as possible, but do not cancel them, as that can actually have a negative effect on your score. The next 10% of your score is based on the mix of credit that you have. Lenders like to see that you can handle different types of credit, such as mortgages and credit cards, stuff like that. So the better mixture you have, the better you look in the eyes of lenders. The last 10% of your credit score is based on new credit. If you start going out and getting a bunch of new credit in a short period of time, it's going to look really bad in the eyes of lenders and you're going to look suspicious to them. Therefore, it's going to hurt your credit score. Now that we've talked about exactly how your score is calculated, let's talk about how your credit score actually affects your interest rates, which will affect your monthly mortgage payments. In order to get a home mortgage, the requirements for FHA loan is that you have a credit score of 580, and the requirement for a conventional loan is that you have a credit score of between 620 and 640, all depending on the lender. Just meeting that minimum requirement for your credit score doesn't mean you're going to get the best deal, however. Your credit score greatly affects your interest rates, which of course will affect your monthly mortgage. So let's break down exactly how your credit score will affect your interest rate. Here's the general rule of how your credit score will affect your interest rate. From 850 to 760, that's where you get the best interest rates. From 759 to 700, your interest rate are raised by around 0.2%. From 699 to 680, your interest rate will raise another 0.2%, and from 679 to 660, your interest rate will raise another 2%. Once your credit score drops below 660, that's when the interest rates really start rising. From 659 to 640, your interest rate will raise by 0.43%. And from 639 to 620, your interest rate will raise 0.5% or 0.5%. Once you go below 620, you're going to have a hard time finding a loan. And even if you do, they're going to require a pretty large down payment. As you can see, having a good credit score can make a really big difference on the interest rate that you'll get. If you just look at this example, if you have a credit score of 770, you can get an interest rate of 6%. But if you had a credit score of 630, then your interest rate would raise to 7.5% or over 7.5%. That's over a 1.5% difference, which will make a huge difference in your mortgage payments. To give you an even better picture of how your credit score will affect your monthly mortgage, let's look at another example. So let's say if you had a perfect score of 850, you get an interest rate of 6%. You're looking to buy a $300,000 home with a 3.5% down payment. With that, your monthly mortgage payment would be $2,396. Now, using that exact same scenario, this is how changing your credit score will affect your monthly mortgage payments. As you can see, there's almost a $300 difference monthly between having the worst credit score and having the best credit score. Now, I don't know about you, but for me, $300 a month is a lot of money, and I don't want to have to pay that to my lender if I don't have to. A common question I always get as a realtor is, what should my credit score be if I'm looking to buy a real estate property? I like to tell them to have a credit score of at least 660, because anywhere below 660 is where the interest rates start rising a lot. Of course, the better credit score you have, the lower your monthly mortgage payment would be. So always try to get it as good as you can. But I say to always aim for at least a 660, because anywhere below that and the interest rates just start to get ridiculous. Hopefully now you see why your credit score is so important when it comes to buying a home and getting a mortgage. With that being said, what are some ways you can increase your credit score? The first thing you should do is make sure to pay off any past due bills you have. Remember, paying your bills on time is 35% of your credit score, and lenders don't like to give money to people who aren't paying their bills on time or who have a history of not paying their debts on time. I say focus on any past due debts you have, pay those off as quickly as possible, and doing that will give you one of the biggest jumps in your credit score. While paying off your past due debts is important, once your debt goes to collections, it may be too late to pay it off. That collections is going to be on your record at that point, whether you pay it off or not. If that happens, I would say to only pay off that debt if the collection agency agrees to take that off your record. Otherwise, you might be better off just waiting for it to fall off. After you pay off your past due debts, the next thing you want to work on is lowering your credit card balances. Lenders like to see your credit card balances at 30% or less. So in other words, if your credit card has a $10,000 limit, lenders want to see your balance at $3,000 or less. I would focus on lowering the balance of one credit card at a time, because if you do that, you'll not only increase your credit score, but you'll also increase the amount of money that lenders will be willing to give you, because you'll be lowering your minimum credit card payments. Now let's say you don't have any credit history at all. You've never gotten a credit card in your life and you just despise them. Lenders would not lend to you if you don't have any credit history, and FHA actually requires that you have at least 2 lines of credit before they lend to you. So in that case, your best bet is to get 2 credit cards and to keep the balance as low as possible. When I first started building my credit, I had 2 credit cards and I only used them to pay gas for my car, and I would pay them off as soon as possible to keep the balance low. That helped to raise my credit score. Alright guys, once again, if you have any questions for me about credit scores or how they affect buying a home, feel free to reach out to me through the comments below or through my website. Thanks a lot. Have a good day.